Folks. It's Dave Burrows. I want to welcome you to a sunny Tuesday afternoon webcast here in the middle of September. We've had markets that have been reasonably uneventful. And today, what we're going to do is we're going to take a tour, sort of from a top-down perspective, take a look at some of the things that are going on in markets, see what's changing, see what's not. Because, of course, at this time of year, lots of folks think about falls of the past that have been eventful. And there's no shortage of news flow out there. We're through second quarter earnings. We're solidly into third quarter. And very soon we'll go back into, an earnings a news blackout period and a buyback blackout period at the end of September. So I've asked Emmett Joshi to jump on today with me today. We're going to talk about a couple things, but in the order of keeping things timely, let's move on. So starting out just from an equity perspective, we continue in this structural bull market. It's been going on 12 years. We've stayed steadily above this rising 200-week moving average. And frankly, month by month since the early spring, market has been working its way higher in a very orderly stair-step pattern. So far in the month of September, the S&P is up 0.72 of 1% after a positive August. That is unseasonably strong. We talked about the fact earlier in the year that when the market comes into a difficult time of the year with good, solid breadth conditions, it tends to be that the market's okay. I put this up each of the last few weeks to remind us that the first half of September is one of the weakest 2-week periods of the year. And of course, second half of September is the weakest. And so we keep that in mind and we watch the data. But so far, no sign of this, weak outlier month of September. And part of that is that, frankly, earnings revisions have been broadly positive, where often by the time you get to September, it turns out that analysts have been, just too optimistic and they have to start cutting their numbers. I think analysts probably got a little more cautious early in the year. So when we look at the S&P, in the near term, from the low back in October of 2023, market's been working its way higher since spring, and we're sitting within a whisper of new highs. If we look at the NASDAQ 100, it's quite similar, quite positive characteristics. And if we look at the equal weight, this is the one thing that's a little bit different. We do see that the S&P equal weight has been unable to make new highs going back to November of last year. But again, it has been working its way higher. I do note that the momentum has waned a little bit in the equally weighted S&P, so we'll keep that in mind. If we look at the equal weight NASDAQ 100, again, it highlights that there has been a fairly concentrated market. If you took the market cap weighted NASDAQ 100, it is trading near highs, as we just said. This is the relative strength versus the S&P. So under the surface, beyond a few of the real winners on the tech side, tech has not been as strong as we have seen recently. And this is a chart by Jerry and Timmer at Fidelity, which I think is really an excellent chart. It takes a look at the breadth in the market versus the rallies over the last number of years. And you can see that, for instance, in the late stages of the Nifty 50 in 1972-73, where the market became obsessed with the 50 companies with the best ability to raise their dividends, companies like, McDonald's and Polaroid, Philip Morris, where if you look at the right-hand axis, the percent is falling. It means that a smaller percent of stocks were actually beating the index. So, for instance, January 1973, only about 28% of stocks were beating the S&P, which means all the return was coming, from those few stocks. In the tech bubble, 1998 and 2000, you could see that we got to a point where really only about 30% of companies were beating the S&P, which meant you really had to be right, focus in some of those strong stocks and pick your spots, even though the return in the market, was very strong. And in February of 24, so a year and a half ago, the market was very, very concentrated. Only 25% of companies beating the S&P, and that's been getting a little bit better. So what do we take away from that? Well, the market is becoming somewhat less reliant on the Mag 7 for returns. More companies are beating the index, but it's still fairly concentrated and maybe early days. But, S&P has been having a good rally. Now, if we look at the developed market ex-US index, so that's the rest of the world, you can see that over the last number of months, we've started making new highs. And we've said that that's significant because when the market goes a long period of time without making a new high, in this case, all the way back to 2007, and then eventually starts making new highs, it tends to be that you've entered a new structural bull market. And this is continuing to be the case. August was solidly positive, September so far solidly positive, and we can see this around the world. So this is the Eurozone MSCI index, marching higher. The Japanese index, the Nikkei 225, making its first new monthly highs going all the way back to 1991. And a structural bull market can be prolific. The bull market that ran from 1966 to 1989, which is 23 years, the Nikkei was up 2,800% before it went into the structural bear market. Now, we don't know what the future brings, but we do know once a structural bull market starts, it tends to go on for several years. And so it shouldn't be a surprise that Warren Buffett over the last 2 years was a buyer of Japanese stocks. Relative value was very, very good. And some changes in the index leadership meant that some of the companies in financial services started to lead, the big Japanese trading companies. Under the surface, smaller companies in Japan are having a rip-roaring year. When we look at what's happening in the small cap market, it's up 42% over the last 178 days. And again, that Topix index, 1,500 companies, only just 2.5 months having made new all-time highs. The market in Singapore has been quite strong. Frankly, Asia, this is the Asia large cap 50. You can see the tear that it's been on the last 4 days. Boom, 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 on to make new absolute and new relative highs versus the S&P 500. Africa, on the back of some of the things that are happening in natural resources, marching its way higher, very strong relative performance. And some of the countries in Peru, that's the last 7 months in the market in Peru. And again, that goes back to 2013, over a decade, where they will make new highs. So developed markets performing really well. This is emerging markets. This is the Dorsey Wright Emerging Markets ETF PIE. You can see very strong relative price performance versus the S&P. So what does this mean? It means that investors have choice. It means we don't have to be so concentrated in the companies that everybody owns. Even the TSX, this is the last 12 or 14 months since we got to a point where the Canadian central bank started to ease. You've seen the Canadian market performing well. So in simple terms, MSCI All World Index relative to the equally weighted S&P. Well, after a first push higher on a relative basis, a reversal in this long downtrend, we consolidated for 6 months and we are just now breaking above these highs, maybe to start the next leg of relative outperformance. And the TSX is a similar boat. So we highlighted last week, when global markets start to make new highs, and it's on the back of a high percentage of markets participating, it means that there is solid demand for the equity asset class. Now, we've spent the last 4 years talking about the fact that one of the biggest drivers for markets is the devaluation of purchasing power of currencies. And one of the ways we protect against inflation is to own companies that have the ability to raise price. Frankly, if you looked at the stock markets in countries where they wound up with hyperinflation, stock markets have often gone straight up. It's one of the ways that we can protect against purchasing power. So no change here. That's really positive. And, obviously there's a significant differential in valuation between US companies and global companies. And it's not to say there isn't earnings growth in the US to support valuations. Earnings growth has been superior in US markets, but we are seeing improvement in earnings estimates for global stocks as well. So if we look at returns really since beginning of 2024, equally weighted S&P is up 28% Canadian dollar terms. The MSCI All World ex-US Index in Canadian dollars up 37. The global fund that we launched on the 29th of December 23 is now up just under 50%. And we're really pleased with the diversification that is providing, our account base. Moving on to bonds. We've talked about this for a long time now. 30-year yields have been sticky, moving higher since 2020. Over the last 5 or 6 months, we've moved sideways. And that means that bonds haven't fallen further in price, but frankly, they're not moving higher. When we look at the TLT, we've seen a series of lower highs and lower lows. So the TLT is the 20-year to 30-year US Treasury bond ETF. So an ETF that owns long-term Treasury bonds. And after a long period of performance since 2020, really negative performance, it continues to be in a bear market. Moving average continue to move lower. We'll see if at some point lower short-term rates can drive demand for long-term bonds. At this point, it's still solidly in a downtrend. On commodities, commodities continue to march higher. Since the global central bank stopped their interest rate hikes, commodity prices have broadly been working their way higher. Now, some are better, some are worse. The obvious winner has been gold, one that we were on early, thankfully. On a monthly by monthly basis, gold prices have been marching their way higher, ticking above at one point today, above $3,700. Now, this seems like it may be an extended rally, but you can see this. In the last bull market, it started in 2003 and ended in 2011. The first leg of the bull market got to 78% above the 200-week moving average. The second leg, 83% above the 200-week moving average. At this point, it's 60% above the 200-week, which pales in comparison to either of those first two rallies. So no sign that this is coming to an end anytime soon. Of course, it can correct at any time, but we know central banks have been buyers, and the rise in price in gold and the purchasing that central banks have been doing now makes gold a larger percent of foreign reserve than U.S. Treasury bonds for the first time since 1996. So central banks are doing this for a reason, obviously, and private investors are getting involved, but still a very small percent own gold. The average portfolio manager and investor just over 2%, 40% of investors less than 0. So gold relative to NASDAQ certainly is providing some competition on a relative basis, outperforming now since 2023. And again, last time this started, it went on for a decade. Commodities relative to bonds are outperforming inflation-oriented asset versus disinflation assets, and commodities relative to the equal weight S&P have now been outperforming for about 12 months. So the market message continues to be that inflation is a risk that investors believe is going to be with us for a while based on their behavior. They're buying inflation-oriented assets. And part of it has to do with the fact that the US dollar has been broadly weakening since 2022. It put in its first high in October of 2022. We put in a lower high in the early part of 2025. We broke support, and the dollar has been unable to rally versus the euro, the yen, the pound, the Canadian dollar, the Australian dollar. Now, should the US dollar continue to weaken, and should global stocks continue to outperform US stocks, it's very possible that global investors will be incented to reduce their holdings in US stocks and bonds in favor of more local market investments. Certainly, global bonds have been outperforming Treasury bonds, and that's a strong incentive. So look, we all have a choice as to where to place our funds. I think the easy thing to do is to have a little bit of everything. Frankly, I think that we can be more informed than that. These long-term trends start, they tend to persist, so we can tilt our portfolios to areas of the market that have a structural tailwind. Our job is to identify market leadership and then remain open to finding new leadership when it emerges so that we can adjust our holdings. And, as we've seen at times in the past, sometimes there is no leadership, which means sometimes it's okay to be on the sidelines. But we're trying to take a tactical approach to this. And we're trying to, in an iterative format, tilt the portfolios toward those assets that have strong risk reward and clear leadership in the market. 70% of return comes from getting to the right neighborhoods. And we use our breadth-based models to help us to do that, where we can find parts of the market that are seeing a rising percent of securities participating and rallying. That's money getting put to work. And we want to focus on those areas. We want to then find companies out of the global universe that meet our business tests. And we rely on a couple of factors. There's all kinds of white papers over time that say if you buy high quality securities, companies with improving income statements and balance sheets, and strong technical factors, you can outperform the average stock. And frankly, we want to find companies that are outperforming their peers, companies with strong relative performance versus the market or versus their sector. And when we can find companies that are good getting better, that are behaving constructively from a price perspective, in other words, showing relative strength or momentum, that's where our portfolio should live. We're trying to find good getting better securities and parts of the market that are seeing net inflows, and that's a universe that changes over time. So, of course, the last piece of it is we need to be good sellers. And from time to time, we're disappointed by what's going on. When Brent starts to deteriorate, we got to be prepared to get more defensive and stop putting on new positions. So when that starts to happen, we raise a little cash, we tighten up the stop losses that we use on all of our positions. And in the event that new money comes in, we stop putting on new positions until Brent starts to improve. Now, for equities, Brent has been very resilient around the world. The percent of stocks in uptrends, as measured by bullish percent, the percent of stocks in Canada that are in clear higher highs and higher lows has been rising. The indicator is green. Breadth is expanding. In the NYSE, breadth is expanding. In the global universe of equities, breadth is expanding. Frankly, if we just measure the percent of global markets that are in an uptrend, that's been expanding. Broadly, the percent of stocks trading above their 50-day moving averages has also been expanding. That's a measure of short-term trend. There's a little check back in global stocks this past week. But on the other hand, the percent of stocks with positive weekly momentum expanded everywhere. Percent of stocks making new highs versus new lows is getting higher. We like it when new highs are outnumbering new lows. It means it's easier to make money. And the percent of stocks trading above their long-term moving averages is rising as well. So there's a lot of green on this screen, which means that coming into a seasonally difficult period, we got a pretty good backdrop. Now, I've always been a big believer that markets behave the way they are set up coming into an event. Should there be some kind of adverse news event, when breadth has been improving, it tends to be that markets are very resilient. When money is in motion, getting put to work, it's hard to stop it. So we watch for deterioration in breadth, but at this point really can't point to it. On the leadership front, industrials continue to financials continue to chug along in the US. Companies like Morgan Stanley just made a new high today. JP Morgan performing really well also. Nice rising relative strength versus the S&P. That's a good sign when investment banks are making new highs. It tells you that investors think in general business conditions for a capital markets bank are strong. They're not betting against it. So Morgan Stanley better than 85% of companies in the S&P over the last 52 weeks. Frankly, the Canadian banks are behaving more constructively, broadly strong through the last quarter, and global banks acting well relative to the S&P and relative to US banks. So no change here. Eurozone financials just only about 6 months into a new long-term bull market and valued very favorably. On the industrials front, they've been strong over the last couple of years, but you can see relative strength has been weaker over the last couple of months. Now, every company doesn't behave the same way. There's good, there's bad. It could be that the industrials are just consolidating. We'll have to see. But I do note that it is now the equally weighted ETF VIS is trading below the 50-day moving average for the first time going back to the spring, something to watch. A lot of the weakness has been in transportation stocks. Transport's unable to go back and make highs since November of 2023. It's a broad-based group. And aerospace in general has been a leader, still trading above the 50-day, basically sideways over the last 2 months, trading better than 81% of companies in the S&P, but we'll watch this relative strength trend. We'll watch the breadth. The companies in general were focused on GE Aerospace, have been very, very strong. Raytheon's been strong. But we had a disappointment this week with MDA Space. Now, I talked about this only a couple of weeks ago. This is a company that is in the business of building satellites and other equipment for the space industry. I've asked Amit Joshi to jump on. This is a company that he spent a bunch of time covering. You may have known there was some news yesterday that EchoStar agreed to sell some of their spectrum, and EchoStar is a customer of MDA Space. So, Amit, are you there?
I am, yes.
Maybe tell us a little bit about what happened here and what our thesis is going forward.
Sure. Thanks, Dave. Yeah, it's always disappointing and surprising when you have a company that you've done a lot of work on and know fairly well be down as much as MDA was yesterday on the back of a contract cancellation. But I thought maybe we'd take a moment, one, explain to investors what we like about this stock, and maybe give a bit of background on what the situation with EchoStar was, and then provide a bit of context of what this means for MDA going forward. So, like you mentioned, Dave, this is a company that's leveraged to the growing theme of the space economy, which is in its very early innings, first, second earnings at best. And they operate in three key verticals: robotics and space operations, satellite systems, and geointelligence. So there's a lot of runway in a very large addressable market that MDA can play in. The reasons that we've liked this stock and continue to like it is the massive backlog that they have, which provides multi-year revenue visibility and the financial discipline. It's a very clean balance sheet. They generate positive free cash flow. They've been ramping up a new facility in Quebec, which would provide more scale and increased efficiency in a growing market. And they've been very strategic about acquisitions. They recently had acquired a company called Satisfy, which manufactures satellite chips that they're going to be integrating with their satellites, bringing in some vertical integration, which would also add to some costs and revenue synergies once they start integrating that. So to give a bit of back,
Tell me about the news yesterday morning and what that means for their backlog,
yeah,
and
definitely.
what percent of business EchoStar represented.
For sure. So, a bit of background. So, the EchoStar deal was originally announced on August 1st of this year. It's a $1.3 billion US deal for 100 satellites. The MDA stock rallied about 18% on the back of this. So it's about 1.3 billion of just over 6 billion in backlog. So it represents about a 25% of the backlog itself. Now, with EchoStar, some of the background here and is that and it's been well documented, is they've had some issues with the U.S. Federal Communications Commission, with them having some spectrum and holding on to it and not building it out. And, there's some whispers that SpaceX had been lobbying the FCC to get their hands on some of EchoStar's spectrum itself. And earlier, EchoStar had actually sold some of their spectrum to AT&T. Most thought that this would be enough to relieve some of the concerns that the FCC had. However, it seems like they were continuing to be forced to sell the spectrum, which was the news that broke yesterday, that they sold that spectrum to SpaceX for $17 billion. So essentially what that means is EchoStar then came back to MDA and said that they had a change in strategy and they would no longer be building out their constellations themselves, and SpaceX would be taking that over. So it required a cancellation and termination of the contract itself. What this means for MDA going forward is a part of the release, what was announced was that the termination actually has nothing to do with MDA's capabilities or products or anything like that. And it was all due to the fact that there was a change of strategy at EcoStar. So, taking a look at that, um, we've seen from the contract terms that there will be some reimbursement for the costs that they've already incurred, some termination fees related to that as well. The amount of those and the timing of that payout is unknown at this point, so we have to wait for that. I think one of the key things that we think of is what's the risk of further contract terminations. And I think that would be limited given that this was more of a one-off situation with EcoStar and the FCC, which resulted in a contract termination. Outside
So,
of
so
that,
sorry,
sorry,
go
yeah, go
ahead.
ahead. Yeah, so outside of that, even without the EcoStar contract within the pipeline of backlog is still robust. It sits at over, just around $5 billion, gives more than 4 years of revenue visibility. And on their conference call after this news broke yesterday, MDA management talked about the conversations that they've been having in terms of their pipeline. It's still very active. There's lots of conversations with a lot of parties. Like we mentioned, this is, early days for the space economy. So there's a lot of work to be done. It wouldn't be surprising to see more contract announcements over the next 12 to 18 months. And I think what you are seeing from, SpaceX and the EcoStar development is how valuable the spectrum and building out some of these device to device constellations will be. And this is an area where MDA will be directly exposed to.
Right. So look, we always have a fundamental view on everything that we invest in. We're looking for things, as we've said, that are good, getting better. And at the same time, we recognize that every position is not going to work out. So we may have a fundamental view that the backlog is robust, that there's lots more business to do. It comes back then to the technical picture. Is the stock broken? So I would just highlight this is the rising 200-day moving average. This is the point that it broke out at $30. And at what price do we say uncle and move on, given the fact that we only need 20 to 30 securities in a portfolio? What's it going to take to change our stance here?
Yeah, I think it would be that break in that, $30 mark where we talked about is, there's some support there. It's probably between we're sitting at today, call it $33. I think, 31-ish is probably our kind of line in the sand, $30 in that area is probably where we're looking. I think what we've been constructive about is the backlog and their capabilities. And that continues to be there. And, there's nothing here that felt anything that's specific to MDA. But once again, we'll always follow on our technical view and give the stock a bit of space to let it kind of digest the news of this week. It was nice to see that even with a lot of volume today, the stock did not move lower. It kind of held from yesterday. So we'll keep an eye on that and then kind of see how it trades over the next couple of days. But it's a situation that we're watching very, very closely. And if it breaks down further, we'd look to move on and at some point keep it on our radar because we do like the story fundamentally. And if the technical picture improved, it's always something that we would look to own again.
So I always like to take situations like this and use them as examples. Look, we use stop losses on our positions. The stop losses we lodge on our trading desk. We don't have sitting out there in the order book, for someone to pick off on what I call a break in liquidity. Most often, when you have a stock breakdown in price, there's some fundamental change taking place, and that doesn't happen from a Friday to a Monday morning. This company was trading with a relative strength of over 90. You can see that there was a break in price from mid 40s to low 30s. I call that a break in liquidity. In other words, there was just no bid in between. We're never going to push something over the edge of a cliff on a break in liquidity. Um, Frankly, there's no win in doing that. So now we see over the next few days whether the stock can hold this technical level and rally off it, or whether it gets worse, in which case we'll move on. But I think stop losses and selling discipline are important. And this is one of the rare opportunities where something broke literally from a Friday to a Monday morning, and we'll see where we go from here. Now, thankfully, this is all about having a portfolio and having a portfolio approach. Our other industrials are behaving really well. And from a sector perspective, I think our positioning pretty strong. Materials continue to strengthen. The gold producers have been obviously very strong. The silver producers have been very strong. Relative strength continues to ramp higher, made a new relative strength high today in the gold miners seniors ETF. Interestingly, investors still really are not on board. This lower line here represents net new money into the gold miners ETF or out of the gold miners ETF. And outside of a few spotty days in the month of August, largely there have been still no flows in, even over the last 4 days, money coming out of the ETF. That's healthy. It means that there's healthy skepticism in the market. People haven't seen gold stocks rally for a long, long time. Today, we had some more news in mining. This is the copper ETF. We've been highlighting that it's started to break out. Today, we had news that Anglo American and Teck Resources are going to attempt to merge as a merger of equals. The head office, it looks like, would remain in Canada, in Vancouver. They will commit to making significant investments in the Canadian mining industry. It would make the fifth largest copper miner in the world. The stock reacted favorably, up about 15% on the day. But it's not so much the company news, but the sector change that is important. There is money looking to be put to work in the copper sector. And early days in a bull market, it tends to be that the cheapest place to buy copper is on Bay Street or Wall Street. So companies will step up and acquire other companies that they feel are favorably priced. But certainly not a bad thing for the copper miners, because it generally, where there's one deal, there's more. And we've been really happy with what's happening in the sector. Now, we are starting to see some flows into that sector after about 18 months of no flows. And our major position, Hudbay Minerals, has been a star. It's about the best performing copper stock in North America since we've been in the position. So really pleased with what's happening in basic materials. The miners, metals and miners ETF, which is gold, base metals, and steel, is only 3 months having made a new high, going all the way back to 2011. And the uranium producers also performing really, really well. Cameco would be our one big position here. Now, Cameco is up 80% since it broke out of the bear market that went 2007 through 2024. That's significant. But when you put it against what happened in the last commodity bull market, it was up 2,250%. So we think it's probably pretty early days. So materials continue to behave well. Communications has been about the brightest spot in U.S. stocks. This is the sector that encompasses Meta, or Facebook, Alphabet, Netflix, Electronic Arts. Our big positions here have been Google. Google was up 15% in the last week on notification that they would not have to sell their Chrome browser. Google made the case that it was going to be important in the next phase of AI modeling. And so Google trading better than 90% of companies, and Netflix resumed after consolidating. You can see the relative strength line has remained intact in an uptrend. So this has been a great group. On the video game side, Take-Two Interactive, also in the communications sector, made a new all-time high yesterday, and relative strength firming nicely. So communications continue to be strong. Sea Limited, which is video games in Southeast Asia and Latin America, also e-commerce, a position we put on several months ago as we're building out our global weight. Again, new closing high as of today. So technology as a whole is consolidating a little. It's one of the reasons why we have an underweight in the sector. Semiconductors also have been consolidating. But another one of our key holdings, again, this is about targeting, Broadcom up 15% over the last week as they announced a couple of custom chip deals. OpenAI is making a deal with Broadcom to build a custom chip for their AI engine. So again, I think this is about rifle shot. It's not about owning the index. There are haves and have-nots. The energy sector, while it's been consolidating, is threatening to break out. Certainly in the Canadian market, we've seen 64% of companies get back above their 200-day moving average, which means that breadth is improving. And in particular, our biggest weight would be Imperial Oil, which has been way outperforming the group, made a new all-time high today, up 3.6% on good volume. So, still early days in a bull market in Imperial Oil. We'll see how far it can go against groups that are not participating. No real change here. Consumer staples continues to relatively underperform. Utilities continue to relatively underperform. REITs continue to relatively underperform, and pipelines continue to relatively outperform. What is the common characteristic? They are all high dividend paying stocks with not so much dividend growth. We prefer lower yielding companies, but with higher dividend growth. So this is the NOBL Dividend Aristocrats ETF. You can see relative strength made a new low today. And if we compare the dividend growth ETF RDVY against high dividend paying stocks, two different characteristics. Dividend growth is continuing to relatively outperform. And we think that it's important that we take note of that. From a sector perspective, average sector, just under 50% of stocks in uptrends. You can see broad-based. Most sectors are in capital letters, which means breadth is expanding. The strongest sectors continuing here at the right, banks, precious metals, regional banks, steel, aerospace, insurance. These are important groups to us. At the other end of the spectrum, forest products, healthcare, food, software, medical devices, just not really participating in housing. So this is a market of stocks, and it is important to understand where the money is getting put to work and focus our attention in those areas. In the portfolios across the firm, financials continue to be the biggest weight, but we did have it come down slightly this week. We reduced some of our position in the TSX group. The exchanges have performed a little bit weaker. It's just about a 1.5% reduction in weight. Industrials are 15% of our portfolio, just about twice the market weight. Materials now in the number 3 position at just under 13%. A lot of that just market growth. Technologies down around 12%. So a significant underweight versus market, but I think we've got great companies and they are outperforming. Communications is slayed out, overweight. Energy is an overweight. And then at the other end of the spectrum, in the most defensive groups, government bonds, real estate, utilities, staples, healthcare, really not very much exposure. And notably, only 3% weight in the consumer discretionary sector, which is the one that would get hurt if things slow down. This week, we had news of employment revisions. Just about 1 million jobs were overstated over the course of the last 52 weeks. I think that gives pause to some folks to think about consumer spending. And we've been a little bit cautious in that area. So look, we're always waiting to see risks show up. You never know where it's going to come from. We watch the bond market for signs that bond investors are getting concerned about credit risk. And when we look at the excess return bond investors are demanding to get paid for corporate bonds versus government bonds, it's about as narrow as it's been in several years. Meaning bond investors are not demanding a premium for corporate bonds. And same thing for high yield. High yield actually is about as narrow as it's been since 2021 or 2014. From a volatility perspective, markets behave the best when volatility is in a low range. And we are solidly right in the middle of bull market territory. So it's September and anything can happen. But when breadth is improving in the background, it's hard to imagine a significant market hit. Market's up about 0.72 of 1% on the month after a stronger month in August. It's behaving quite well. We'll watch for signs of change, and if so, we get more defensive. But the beat marches on, and we're pretty fully invested, a little bit of cash, and we'll keep on updating this stuff on a weekly basis. For those who want to follow during the week, I am posting pretty regularly on Twitter at Barometer CA. Of course, our webcasts are always available on our webcast after the fact, our website after the fact, or on YouTube. If there's stuff that we're not talking about, please let me know, and we'll see if we can answer. And let's take a look and see if we have any questions. Looks like we've got a couple. So John Nickel was asking, based on our stop loss, if we were stopped out of MDS, and I think we explained that. The one thing that will stop us from hitting a stop is a break in liquidity, where something gaps way beyond where we would stop our way out, and then we have to assess. Having said that, before we were adding more, we'd want to see the technical picture start to improve. Lawrence, I don't yet have any uranium positions, and I've been looking at URA, which is the ETF that holds uranium producers, or HURA. Do you think this is still a good time? We own both the URA and the NLR, which is nuclear power companies. It includes uranium producers and equipment companies. I would be comfortable owning either of those, and we own Cameco kind of as the leader from a producer's perspective. Let's see. Question, do we own any shares of First Service hitting new highs? Would you buy? We don't currently own First Service, and I have to be honest with you, I haven't taken a close look at it recently, so take a look at that and we can comment next week. A couple of very nice comments here also. Oh, and an anonymous attendee, if you had tech shares, would you sell? So technically speaking, tech has been weak relative to the group. I think they've got great assets, but they've been unable yet to optimize their QB2 mine. I think ultimately, if this deal gets done between Anglo and Teck, it will create a powerhouse that is highly concentrated in copper. Something like 70% of revenue will come from copper, which is significant relative to other senior base metals companies. So I think that I would be a holder of the stock here. It's probably going to chop around a little bit over the next few days or a couple of weeks. But my guess is that people will recognize that this would likely be a very strong company. It'll be strong from a copper production perspective. They'll be strong from a technical strength perspective. They'll be strong from a balance sheet perspective. And I think it's going to be pretty attractive. And there is also nothing to say that there couldn't be another bid. If another company had intentions, this might cause them to come out of the woodwork. So I would be a holder, but our preferred position in copper is Hudbay. We also own Freeport, and I think the sector backdrop is quite good. I think that's all the questions we got. I appreciate everybody jumping on. Amit, thank you for coming on. It's never fun to have to come on and talk about a stock that hasn't worked out recently, but there is no perfect in investing. This is an iterative process, and you got to take news as it comes. Sometimes there's not a lot that you can control, but it gives us an opportunity to talk about how the stops work. If there's stuff that we haven't touched on that you'd like us to touch on, please send us a message or give us a call. We're always happy to take a phone call. We are busy trying to set up a bunch of reviews with clients. It's the time of year. If we haven't spoken to you recently and you'd like to have a call, don't wait for us to call you. Send a message or let us know, and certainly happy to get on. It's not like there's so many families we don't have time to talk. We have lots of time to talk. So thanks so much, and we'll see you again next week.